GEVO was jumping for joy after it reported its Q2 earnings that exceeded expectations, achieving a net income of 1 cent per share, beating estimates of a loss of 6 cents per share, while revenue was $44.7 million, along with cash and cash equivalents, which stood at $127 million at the end of the quarter. GEVO's GEVO North Dakota segment reported an income from operations of $17.1 million. The GEVO RNG segment reported an income from operations of $1.5 million. The company also sold voluntary carbon credits and tax credits, enhancing revenue streams. This was covered in greater detail during the previous GEVO video 2 weeks ago. Progress is being made on its alcohol-to-jet ATJ projects, with a focus on deploying a 30 million gallon plant in North Dakota. GEVO has a strong intellectual property portfolio with over 400 patent assets, supporting long-term growth and innovation. However, the company faces challenges in monetizing biogas credits, with ethanol-related CFPCs being prioritized. During the Q&A session, management discussed the monetization of biogas credits, the cadence of clean fuel production credits, CFPC's sales, and the growth prospects of the carbon dioxide removal (CDR) market. The expectation is to monetize the rest of its greenfield production tax credit for this year, with a pathway identified for 2026. GEVO's CEO, Patrick Gruber, emphasized the company's focus on being cost competitive with petroleum-based jet fuel and completing the engineering and financing for the ATJ-30 plant. The aim is to grow its CDR sales over the next 2 years, focusing on high-quality credits. CFO Oluwagbemileke Aguirre stated that the $10 million benefit per quarter from CFPCs is a conservative estimate, and the company believes it can do better than that. Overall, GEVO's strong financial performance and progress on its ATJ projects position the company for long-term growth and innovation in the renewable energy sector. However, the company faces challenges and uncertainties, including the slow progress of the ATJ-60 project and the expiration of the 45Z tax credit in 2029. The strong second quarter was driven by the growth of carbon dioxide removal, CDR credit sales, and clean fuel production credit, CFPC sales. GEVO anticipates growing CDR credit sales to $3 to $5 million by the end of the year, and estimates long-term sales of this new co-product could exceed $30 million per year or more from the GEVO North Dakota site. By leveraging its specialized capabilities, it can further reduce the carbon intensity of its low-carbon ethanol with CCS and RNG production facilities. GEVO expects to continue collecting cash from customers of credits and applying it to its cost of goods sold, thereby causing a reduction in COGS. The company treats this credit sale as a co-product credit and expects this credit to exceed $10 million per quarter through the end of 2029. As for the low-carbon fuel segment, it's expected to continue to generate durable cash flow due to its competitive advantages, like its wholly owned on-site CCS, which provides its low-carbon ethanol with an industry-leading carbon intensity score. Patrick Gruber commented that the results are delivering on the targets the company said it would achieve this year, even sooner than expected. He emphasized that the company's fuel manufacturing systems are designed end-to-end to abate carbon, and the result is that GEVO can manufacture cost-competitive renewable liquid fuels while abating carbon. CFO Leke Aguirre emphasized the growth reported this quarter represents a step change for the company. Indeed, the focus on reducing carbon intensity and generating durable cash flow from its low-carbon fuel segment could very well drive future growth and profitability. For more on stocks and crypto, follow Ascencore. See you next time.